It may be hard to remember that on March 23rd, the market was down over 32% and we had witnessed the fastest sell-off ever. But the markets eventually rebounded and returned to 18% in 2020. So how did Warren Buffett, the world's most legendary investor, handle one of the most volatile and unique years in stock market history? His portfolio started the year at a healthy $251 billion, but then declined a staggering $70 billion in the first quarter, which was his biggest loss ever. He then staged quite a comeback, gaining $40 billion in the second quarter, $32 billion in the third, and he closed out 2020 with another impressive $35 billion gain, bringing his yearly stock portfolio profits to over $40 billion, which exceeded the key benchmark known as the S&P 500. So how did he do it? This video will review Buffett's portfolio and see if his stocks are worth buying. Let's start by reviewing his biggest position that comprises 46% of his now $274 billion portfolio. Yes, we said 46%. Despite never being a tech investor, Apple will go down as one of his best investments ever, given that the position is now worth almost $125 billion and has produced over $90 billion in profits.
You know, you've always said that you're not a technology investor, and now when you start looking through the holdings.
So I'm not a technology investor.
Wait, they can't hold this. Hold that up higher. They can't see it.
Even better, his returns work out to over 57% on average per year. Buffett was smart to buy Apple in 2016, 2017, and a little bit more in 2018. But at the end of 2020, Apple has gone up so much that the company is now worth over $2.2 trillion, and it's the biggest company in the world by far. So would you be smart to buy today? To see if it's worth buying, let's compare Apple to the other tech giants, Microsoft, Amazon, Facebook, and Google. At first blush, Apple seems to be trading at a fair price, given it has a 39 PE, or price to earnings ratio, which is similar to the other companies. A PE measures a company's value compared to how much it earns. So Apple is worth $2.2 trillion and it earned $57 billion last year, so this ratio is 39-1. But is this number too high? Unlike the other tech firms, Apple grew revenue at only 6% in 2020, which is much slower than these tech giants. Also, many of Apple's divisions have slow or no growth, including the iPhone, Mac, and iPad. So now it may seem that Apple may be overvalued. But two things are helping Apple. Previously, revenue from its services and wearable division were small. Wearables include headphones and watches, and these devices aren't cheap, and Apple is still getting its typical premium pricing. Its services division is mostly sales to consumers through the Apple App Store. In 2015, these divisions accounted for only 13% of revenue, but in 2020, they are now 31%. Even better, these two divisions are still growing very rapidly, and Apple is the market share leader. Additionally, wearables is expected to have huge growth over the next 5 years. As we go to our discounted cash flow model that we have made for Apple, which can be downloaded for free on our Patreon page, it can be seen that if these divisions simply continue their pace of growth, that Apple overall would reach almost 10% revenue growth by 2025. Even when this growth slows in these two fast-growing divisions, Apple should be able to maintain at least 3% long-term growth. But the issue is people mostly buying Apple Watches and headphones or using the Apple App Store are current iPhone users. So when everyone with an iPhone buys a watch or headphones, then these divisions' growth will eventually slow. Still, its services division will have good long-term growth, but overall Apple seems a bit overvalued at this point given its humongous run this year, especially compared to the other tech giants. There is one more risk to Apple. Apple is involved in a high-profile lawsuit with Epic Games, which is the popular video game company that makes Fortnite and a video game engine. While it may seem like a no-brainer that Apple will win the case, on the other hand, governments are increasingly concerned with the growing power of the tech giants, as they comprise almost all the large companies and they make huge profits. So there is a chance of increasing regulation. If say Apple was regulated and they had to provide other app stores or lower its fees, and say revenue in its services division dropped to 0% growth, then Apple stock would be supremely overvalued. There is definitely a possibility of this happening, even if it's only 10%. Because of this, overall we think that Microsoft is the more attractive tech giant, given its better growth, and we review its businesses in our video How Microsoft Makes Money. What about Buffett's next biggest position? The US banks. But before reviewing this position, we wanted to thank Skillshare who sponsored this video. Skillshare is an online learning community that has thousands of topics where you can learn many skills like Excel. My Excel skills helped me build this colorful portfolio sheet showing Buffett's returns, and with Skillshare you can improve your skills to make similar sheets. Or you may want to learn about finance so that you can build better stock valuation models. Skillshare has many topics and it can either boost your learning or help you enjoy creative pursuits like photography or video editing. The first 1,000 people to click the link in the description will get a free trial to the Skillshare Premium membership. There is so much knowledge to gain by signing up, so thank you for supporting Skillshare and us. And now let's see how Buffett has done with his second biggest position, the US banks. Despite some articles in 2020 suggesting that Buffett is giving up on the banks, the fact is he still has a big weighting of 23% of his portfolio or $62 billion in the banks. But it is true that he reduced his banking positions in 2020. At the start of the year, they accounted for 37% of his portfolio or $92 billion. Also confusingly, Buffett has recently made very favorable comments on the industry. For example, in early 2019, he said that the banks are attractive because
it seems like you've got a big weighting in financials, and of course you finally invested in Jamie Dimon's company. Why banks right now?
They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right.
But in 2020, he slashed his JP Morgan position from $8 billion to essentially nothing. Also, Buffett sold out many of his shares in Wells Fargo, despite also recently being very positive on the company.
But you're holding on to Wells Fargo for the foreseeable future.
We'll make a lot of money in Wells Fargo. We've already made a lot of money. And we probably got well over a $10 billion profit in Wells Fargo.
But Buffett has not completely turned his back on the banks. He added 90 million shares, or about $3 billion, to his new champion, Bank of America. So are any of these banks worth buying? Well, first we need to address one thing that will likely appear in the comments. With the current COVID pandemic and everyone sitting at home using technology, it seems that everyone has become a tech futurist, believing that everything technology will soon consume the world. And before people say we are out of touch, please check out our technology videos on Microsoft, Salesforce, Shopify, IBM, and recently on Mobileye, where I predict the imminence of self-driving. Despite Mobileye being tantalizingly close to self-driving, robot bankers are not very close. However, because so many futurists have done so well in 2020, their opinions are now taken too seriously. For example, Cathie Wood has become a famous futurist investor because of her amazing call on Tesla stock. She says this in relation to fintech growth in China.
What we're seeing here, look at this, $1 trillion in 2014 in China's mobile payments, to $26 trillion. That's only 4 years. That was 2018. Talk about exponential growth.
Cathie is discussing how Alipay and WeChat took over China's payment industry. She then infers that this will happen in North America. And us North Americans are seemingly behind the Chinese because we use old-fashioned Visa and Mastercard. Well, she is the one who is actually backwards. The Chinese use Alipay because Visa and Mastercard were banned in China, though Mastercard has recently won some approvals, meaning the Chinese needed to develop a different system. In fact, there is no evidence that the Chinese system is better. In fact, there is clear evidence it is worse. As can be seen in 2017, despite Alipay and WeChat taking over payments, only 1.6% of Chinese deposits were stored in these apps. This means customers used the app then immediately transferred their money back into the Chinese bank after they made a payment because obviously they don't trust the app. Also, Cathie discusses American companies like Square.
And Square's Cash App is number 6. What you don't see in this chart is that both of them will probably, they're growing so much faster, Square Cash at roughly 80% and Venmo at roughly 40%, that they are going to surpass the banks in terms of number of digital accounts.
She gleams how Square has 30 million monthly users, and she compares this to the size of other banks like JP Morgan, who has only about 40 million users. So is JP Morgan really in trouble? However, despite having a similar number of users to Square, JP Morgan somehow has over 2 trillion of deposits compared to Square's puny 1.8 billion. So perhaps the number of users is a very poor metric to use as a comparison when the same users can produce a 1,000 time difference in money stored between the two companies. Okay, so robot bankers are not likely to become a thing for some time, so which banks should we buy in the interim? Buffett's biggest positions are in Bank of America, where he has over $30 billion, and American Express, where he has over $17 billion. We will talk a bit more about American Express soon because it is more than a bank. But let's see which US bank is the cheapest by comparing the 8 biggest banks and American Express. JP Morgan finished 2020 as the highest valued bank by market value, worth over $385 billion. This was followed by Bank of America. But which bank should you buy? If you want to be a bank investor, remember this word tangible equity, as it's a fundamental metric. Tangible equity is tangible assets like cash, less all amounts a bank owes, and it excludes intangible assets like goodwill. So it is tangible assets minus all liabilities. This is considered a rock bottom valuation for a company, and for banks, it is a very realistic rock bottom valuation, as most of its assets can be quickly converted to cash. So a bank should really never trade under tangible equity unless its loans are really, really bad. Based on the price to tangible equity, American Express and JP Morgan seem expensive. But tangible equity is only one part of this key banking metric. The other part is return on tangible equity. Return on tangible equity is what a bank returns on this tangible equity. So it's net income divided by the beginning of the year tangible equity. Say an investor required an 8% return on JP Morgan. The fact it earned 18.8% on tangible equity means that it should trade at least 2.34 times tangible equity. This 2.34 times is calculated by taking 18.8% divided by the 8% required return. It also assumes the 18.8% will continue indefinitely. But JP Morgan only trades at 1.89 times, meaning it is undervalued. Let's now rank the banks on how cheap they are relative to the returns on tangible equity. It seems Citigroup may be the cheapest bank, but all the banks look fairly cheap. But we need to do one more thing, that is factor in growth. JP Morgan should be worth more than 2.34 times tangible equity, assuming it can grow. That number of 2.34 times was based on it never growing. If we incorporate some growth assumptions and we give higher growth estimates for the better banks, we find that JP Morgan, PNC, and Truist, a new bank that is a merger between SunTrust and BB&T Bank, are the cheapest banks. Buffett's Bank of America also looks attractive. But what about Buffett's favorite bank, American Express?
So I like our American Express position very well. Charlie? Charlie, anything on American Express?
Amex holds a special place in Buffett's heart because during the 1960s when he ran his partnership, he put nearly 50% of their money into Amex and he made a killer $27 million profit. We go through this Amex trade during our video, Buffett's 5 biggest trades during his partnership years. What may be confusing to Amex shareholders is Visa and Mastercard, who seemingly operate similar businesses, trade at 40 plus PE ratios compared to 14 for Amex. Even better, Amex may seem incredibly cheap because it has recently reached parity with Visa and Mastercard in terms of being accepted in as many commerce locations in the United States. American Express may seem even better because it's vertically integrated, meaning it is the issuer, the network operator, and the acquirer, while Visa and Mastercard only run the network. What does this mean? Well, the network you can think of as some trusted intermediary that connects your bank to a retailer's bank. When you pay in a store like Walmart, Visa connects your bank, say JP Morgan, to Walmart's bank, say Bank of America. Visa's network allows these banks to talk to each other. The retailer typically pays about 2.4% to the bank for this service, and Visa and Mastercard take only 5% of all these fees, so only 0.13% of this 2.4%. American Express takes all the 2.4% because it is the issuer, the acquirer, and the network operator. But this is where the good news ends for American Express. Despite taking all the money, it also means they are competitors to all the banks, while the banks work with Visa and Mastercard. This competition is seen by American Express having to spend $7 billion in marketing in 2019, compared to only $1 billion of Visa and Mastercard. Additionally, despite spending so much more money on marketing, American Express grows much slower. Also, Amex is more of a bank than a payment network, as more of its earnings are coming through its banking operations than its payment network. Still, we think this is an attractive position for Buffett. Let's now move to his most controversial position, Kraft Heinz. Buffett likes to say,
I've been watching. I was wrong in a couple ways on Kraft Heinz, but I think we talked.
We actually go through Buffett's complex purchase of Heinz, then Kraft in our History of Kraft Heinz video. Buffett says,
You'll go the right direction, but there's real debt to be reduced.
But he also admits that he was part of the problem by borrowing too much debt to make the purchase.
I don't think we overpaid in Heinz, And we borrowed money that related to projections that have not been met. We earn a lot of money, but we were paying out a lot of money, so we had very little in the way of retained earnings to reduce debt.
However, before jumping into Kraft because Buffett owns it and it now seems cheap, remember that debt can also increase returns, and despite Kraft seemingly floundering away, Buffett is actually up quite a bit of money. His returns are almost 11% a year on his money. So debt has helped his returns because he used very little of his own money to orchestrate these purchases. Knowing this, should you buy Kraft? You might think Kraft is attractive relative to other consumer packaged good companies, or what people refer to as CPG companies, because it has the lowest multiple of 11.7 times EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. This ratio is essentially a maximum earnings number. It is basically what a business could earn if it never invested in the future and if it paid no taxes or interest. On the other hand, despite seeming like just a super optimistic number, it is a good number for comparison because it puts all companies on equal footing, as companies that have too much debt are not penalized. Kraft's lower multiple is justifiable because it has had negative growth for years. Its performance has also been poor compared to other CPG companies like General Mills. Additionally, Kraft is predicting its EBITDA to decline to $5.7 billion after COVID. Worse, it has relatively meek future ambitions. It unveiled in late 2020 an uninspiring long-term growth target of only 1 to 2%. Also, this presentation assumes that Kraft can benefit from more cost-cutting. But cost-cutting is largely responsible for the mess it is currently in. For example, in 2012, Kraft spent $640 million on advertising. In 2019, with Kraft and Heinz together, it spent $100 million less. This shows the extent of the cost-cutting, that the combined Kraft and Heinz company would spend less than the standalone Kraft. We also created a discounted cash flow analysis showing what Kraft is worth with 1% future growth, and the stock is clearly overvalued. Also, at the start of 2020, there was real bankruptcy risk for the company as its bonds sank to low levels. COVID has been a major success for Kraft, as people are not going out to restaurants, which has increased their sales. For now, Kraft bonds have rallied as if it's once again a blue chip company, but if its results deteriorate once people start going out again, there's more risk. Overall, we see too much risk from owning Kraft and not enough reward. Let's move to Buffett's final big position and one of his favorites, Coca-Cola. It's hard to imagine, but Buffett was not always a fan of Coca-Cola, and his son once referred to him as Pepsi Warren. But in 1986, Berkshire Hathaway switched to Cherry Coke from Pepsi as its main drink, and Buffett soon bought a lot of Coke stock. He has done very well in this position, gaining over 15% on average per year, and the position at the end of 2020 is worth over $20 billion. So is Coke worth buying? Unlike other CPG companies, Coke and Pepsi are surprisingly not struggling at all. Coke has consistently had strong organic growth, growing at 6% in 2019, 5% for 2018, and 3% in 2017 and 2016. Therefore, the EBITDA multiple for Coke at 22 and Pepsi at 18 doesn't seem too high. The growth also makes them less risky, meaning they deserve a higher multiple. We have also done a discounted cash flow analysis for Coke, which is part of our free sheet. We assume 4% growth for 10 years, followed by 2.5% terminal growth. And we find that Coke should only be worth $48 a share. Coke may be a little overvalued, but I think Mr. Coca-Cola will continue enjoying his sugar rush and the stock position.
I drink probably 5 12-ounce Cokes a day, and that's about 700 calories. And I've been doing it more or less all my life. I can't imagine anybody that feels better than I do. I mean, I'm happy, I enjoy life,
So what do you think of Buffett's portfolio and his returns in 2020? And do you think he will find more successes in 2021? Also, if you enjoyed the video, please leave a like and subscribe, and let us know which stocks you see here that you'd like us to discuss more of. Also, links in the description to our free Patreon sheet and supporting materials. Thank you for watching.